Hi, my name is Marat. I'm a senior analyst at Sovereign. Over the last 3 months, our team has spent hundreds of hours analyzing of new tax code and talking to tax attorneys and accountants. But let me tell you, it was totally worth it because we found this incredible way for you to potentially save $1 million or more over the next 5 to 10 years. Of course, the exact amount you can save will depend on many things, on your income, on type of the business you are in, your personal situation, such as your marital status. That's why instead of presenting you with several preset scenarios, we created an interactive tax table where you can imitate your own situation. And in this video, I'll explain you exactly how to use it. But first, a little bit of tax history. Traditionally, pass-through businesses paid less in taxes than C corporations. It happened because pass-throughs are taxed only once, on the personal level of the owners. Income passes through directly to them, and owners pay the tax on that income through their personal tax returns. But C corporations are very different, however. They get taxed two times. First, on a corporate level, and second, on a personal level, when the owner takes a dividend distribution. As a result, pass-throughs were often more tax efficient than C corps. But the new tax law brought two major changes that completely changed the rule of the game. First, under the new tax law, certain types of pass-through businesses can now deduct up to 20% of their income. The problem is, however, that at higher income levels, this deduction goes down significantly or disappears completely. And the second major change, C corporations have received even a bigger gift under the new tax code. The corporate tax rate in the US dropped from 35% to 21%. So even with double taxation, in many cases, C corporation is the better choice today. Of course, the lower corporate tax was introduced to help huge American corporations such as Google, Amazon, and Walmart. Well, they provide jobs after all. But you don't have to be the size of the Google to benefit from the second change. Converting to a C corporation may make sense even if your business is making $200,000 per year. And C corporation really starts to shine at higher income levels. Well, there's no magic number when exactly C corporation becomes a better choice than a pass-through, since there are many factors to consider. And that's why we created this interactive tax table so you can simulate your specific situation. Okay, let's look at the table right now. So let's start at the very top where we have those attention signs, and they're quite important. Well, because, first of all, this tax calculator provides only estimated tax numbers. You will really need to talk to your own CPA familiar with your own personal information for much more precise answers. Well, and second, this calculator accounts only for federal taxation. So we do not take into account any state taxation, personal or corporate. Now let's get to the input section where you will be actually putting in your personal information. So a little bit about the structure of it. It consists of three different areas. The first one is common inputs, where these inputs are common for all types of business entities that we're talking about. And a little bit about the business entities, we will be talking about sole proprietorships and partnerships. We'll be talking about S corporations and also C corporations. So the taxation of all three of them is very different, so that's why we had to separate them in three different parts. Okay, so these inputs will affect all three types. Then we also have the specific inputs. So those inputs in the middle will affect only tax calculations for S corporation. And those inputs to the right will affect only the tax calculations for the C corporations. We have two different input cells. The first one, like this one, for example, your filing status, is the drop-down menu. So you'll need to click it, physically click it, and then you will see a little corner over here where you will be able to choose between single, head of household, and married filing jointly. And the second type of calculation, you will just need to enter your own data. For example, if you have two kids that are eligible for child tax credit, you put in 2 here. If you have 5, you put 5. But we will leave it 0 for now. Also, we do have the comments in many of the cells and many of the input fields and throughout the table below as well. So if you see on any cell the little red corner to the upper right side, that means that there is the comment, and you need to put the mouse over to read it. And I really encourage you to do that because there's a lot of useful information. Okay, now let's look at some real life example. Let's assume that you are a businessman and you're single, so we'll leave your filing status as single here. You do not have kids. Also, let's assume that your business brings you a profit of $500,000 each year. Also, since you're single, you don't have to put here anything. Even if you put something, it will not affect anything. And another thing, your expected investment return on the cash balance, let's put at 7. So what is it exactly? I will explain you just a little bit later. This is mainly going to go to for calculations of sole proprietorship, so we really need to start putting the information for S corporation as well. The IRS wants you to pay a certain salary, your S corp to pay a certain salary, because the IRS collects self-employment taxes on the salary portion of the S corporation. So that's why if you are making a $500,000, for example, IRS will not let you pay yourself a zero salary and therefore pay zero in self-employment taxes. You would need to put at least $50,000. I would say it will all be very personal depending on your situation, on your business, on your profitability. You will need to talk to your CPA to figure out what is the reasonable salary for S corporation. Okay, so those two fields are important for determining the new pass-through deduction. Okay, so your salary and the salary of your employees will influence how much you can deduct. So the higher the salary you will be drawing, the higher deduction you'll be eligible to. Also, this field, you'll have two choices. You can choose between good business and bad service business. So good business, I will tell you straight ahead, is will be better for pass-through deduction purposes. And the bad service business, unfortunately, will not get a lot of pass-through deductions if your income crosses $200,000 approximately for single people and $415 for married people. So we do cover a lot of this information in the comments as well. You're welcome to read them. Now let's put information for the C corporation. So the rules for the salaries for C corporations are very similar to the rules for the salaries of S corporations. So we will put in approximately $50,000 here. If you want to also collect dividends every year, you can put it in here. But dividends, unlike salaries, dividends are completely optional. Now let's get to the results section of the table. Let's scroll down all the way to the bottom. The next thing you will see in this table is this row, the total tax amount to pay each year. And I would say this is probably the most important row of the whole table because you will see exactly how much taxes you need to expect to pay if you have sole proprietorship, if you have S corporation, and if you have C corporation in 2018. Okay, so you see that the most expensive way of doing business in terms of taxation is going to be sole proprietorship. The S corporation is actually a little bit better, and the reason why is because S corporation can save significantly on self-employment taxes. And as you see, C corporation is actually really shines in this situation. So the tax savings between C corp and sole proprietorship is going to be a whole almost $70,000 each year, which really adds up after a while. And because we know what the tax figures are going to be, we did all the calculations on the background. We do know as well what the effective tax rate is for each structure. So for our C corporation, the effective tax rate is 21.1% because $105,000 is exactly 21.1% of $500,000, which is our business income. And of course, sole proprietorship and partnership, it will have the worst numbers. So the effective tax rate for that business structure is 34.5%. And on the bottom of our table, we do have the cash balance, the accumulation every year. So on the first year, the cash balance is going to be just your business income minus your tax. On the second year, it's going to be your first year's business income plus what is left after paying the tax of the second year, and so on. And this is exactly where the cash balance growth rate up top, if you remember, comes to play, because we account here for the cash growth every year. So, for example, if you can invest your money, you expect to grow at 5% or 7%, so your cash balance here going to be growing at 7% every year. So at the end, it will give you a bigger results. And as you can see in our scenario, a single person, a single businessman making $500,000 a year was able to accumulate the whole $1 million or almost $1 million more with C corporation than he could do it with a sole proprietorship and partnership. What is going to be your personal situation? You will find out after you put in your personal data, and hopefully this number is going to be even bigger than this. Now let's try to change some numbers in the input fields and see how this table interacts. So instead of 7% here of expected investment return on cash balance, let's put 12% and see how the numbers will change below. So you'll see that this number before was $5.5 million for C corporation, and now it went up to almost $7 million. And that's how the power of compounding interest works. Instead of 7%, we put 12%, and at the end of the year 10, you have $1.5 million more. Of course, you will also need to change a lot of other information here depending on your personal situation, whether you're single or married, and what your business profits are. So let's put in different numbers. So instead of 500,000, let's put 350,000. So you'll see the situation have changed, and the balance at the end of the year have changed as well, of course. And now let's talk about the specifics of taxation of C corporation. So the big difference between C corporation and other types of entities is that C corporation is taxed twice. So first time the business profit is being taxed at the corporate tax rates, and the new corporate tax rate is 21%. And after that, once you start taking dividend distributions, you will also get taxed on a personal level that you will declare on your personal income, tax return. That's why C corporations are being taxed twice, while sole proprietorships and S corporations are different in this regard. They get taxed only once, so they're pass-through entities, which means that the income passes through directly to the owners of the business. And owner declares that income only one time at their own personal tax return, and that's it. So pass-throughs getting taxed once, C corporations getting taxed twice. But at the very beginning, C corporations only get taxed on the corporate level, which is 21%. And if you don't take dividend distributions after that, you can delay your personal taxation pretty much indefinitely until you really start taking dividend distributions. And hopefully that will happen when you retire, when your overall income goes down, so therefore your bracket will be more beneficial. But while you wait for to take those dividend distributions when you retire, you can do a lot of things with the cash balance that is sitting in the corporate accounts of your C corporations. For example, you can of course reinvest the money back in the business, or you can invest in real estate, you can invest in precious metals, art, stocks, bonds, or you can even speculate in cryptocurrencies using this money. There are certain rules to follow, of course, and we cover those in our tax report. And one very important thing to mention is that those tax figures over here in the middle of the table, a total tax amount to pay each year, is not exactly apples to apples comparison, because in case of sole proprietorships and S corporations, we indeed are talking about after-tax numbers. So there is no additional tax to be paid here. In C corporation, the situation can be different, because you essentially, with C corporation, you delay the personal taxation, you defer it. Of course, you can grow your money much faster. Punch in your own numbers here to see how the figures change down there, the taxation row over here, and the chances are that you'll be very pleasantly surprised about how C corporation can save on taxes. And this is really, in many cases, depending on your income and depending on your personal situations, in many cases, C corporation now is really much more preferable than S corporation, and way better than sole proprietorship. So yeah, play with those numbers and you'll figure out for yourself. Now let's look at the differences of the full version of the calculator versus the preview version that you received last week. So first of all, you will see that this is a full version just looking at this big stamp, so you will not be able to confuse two different versions. We will pick up where we left in the last video, so I've already pre-filled the same information as we did during the preview. We have a single person making $500,000 in business profit and paying himself a salary of $50,000. And unfortunately for him, he's in the bed service business, so he's not going to get as much of pass-through deduction at the higher incomes. Okay, let's look at the table itself. So first of all, you see that the tax breakdown is now fully open. It was blanked out in the preview version. Now it's completely available for you to see what the taxes are, and you'll see exactly how those taxes are calculated. And you'll see the tax amount. Tax amount did not change compared to the preview. Now let's scroll down to the most important part of the full version. It is the specific calculator for the C Corp, where we can account for the personal taxation as well. When you retire, your income will go down, and then you will be able to draw your dividends, and I'll show you different instances when your personal taxation, when your dividend taxation can be as low as 0. Now let's fill together the information. So if you remember, we over here we put the filing status as single and 0 kids. But let's assume that once you retire, you will be married by that time. So we'll put here married filing jointly. Here we will put the amount of dividends that you want to draw. For example, $50,000 per year. Okay, here we'll put in the kids that will still be eligible for a child tax credit. So maybe you'll have a couple of kids by then, and one of them will be above 17, I mean older than 17 years old. So let's put just one kid who will be younger than 17 years old. And here we will put also the additional income that you and your spouse will be having at the time of your retirement. So let's say your Social Security is going to be at around $45,000 per year for you and your spouse. So you will see we put in your total income at $95,000, and now we need to look at the results. So if you look here, you will see that the result, the annual dividend tax, is still 0. Of course, your taxation of dividends will depend on your marital status, on your income, how much you want to draw in dividends. You're welcome to read the explanation over here to the right and play with those numbers, and you will see the number that will actually apply to you. So for example, if you think that 95,000 is not going to be enough for you, you can increase your dividend distribution here. So let's say you don't want to do 50,000, you want to do 90,000. So you'll see that right away your annual dividend tax went up, and it shows you the effective tax rate on the dividend distribution. So, and if let's scroll back to 50,000 here. This is going to be our most important comparison of different business structures. So the numbers for sole proprietorship and S corporations are exactly the same as above. So let's see, there's 172, 152. So 172, 152, because those numbers are already after tax, so you don't owe anything additional to the IRS. While this number can actually change because this might be the after-tax situation for you, or it might not, depending on how much dividends you want to draw when you retire. So in this case, this number 105,716 is the same as this one 105,716 because your dividend taxation is 0. So this is going to be your apples to apples comparison, and you see the power of C corporation at full strength here. But let's look at the situation when dividend taxation actually applies. So the dividend tax rate is not going to be 0. So for example, you want to take $90,000 in dividends. Your total income is going to be 135 for two of you, for the married couple, and it will show you that your dividend annual tax is going to be $11,500, and this will change based on how many kids you have that are eligible for child tax credit. So if you have 0, it means that your dividends are going to be taxed at flat 15%, and your tax is going to be 13.5. Okay, so let's put back one kid and keep comparing. So you see, do you remember the tax here was 105,716, and effective tax rate is 21.1. It obviously went up, so your apples to apples comparison, the final comparison, is going to be this. So the kind of annual taxation of your C corporation is going to be $117,000 and a little bit more than that, and your effective tax rate is 23.4.